The energy sector is a very difficult one to invest in because of how fast energy prices can change, just like what happened last year. Hello everyone, welcome back to the channel. Today we're going to talk about the energy sector as it was requested in the Discord group chat. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. Also, I have a completely free Discord group chat, which link for that is down in the description below. Now, there are different types of energy companies, as we have the renewable energy stocks such as NextEra and Brookfield Renewable. Then we have solar energy stocks such as First Solar. Then we have oil stocks, natural gas stocks, liquefied natural gas stocks, and electric utility stocks. Even though we like to separate them in groups, there are some companies that are part of different groups or types of energies. But today we are going to talk about oil stocks, some of the biggest oil stocks, and these are Chevron and Exxon. Even though these are oil stocks, I would be more than happy to do a comparison of other type of energy stocks such as utilities or renewable energy companies. Just let me know in the comment section below. Now, these two companies are integrated oil and gas companies, as they find, produce, refine, and distribute crude oil and natural gas. Now, when investing in the energy sector, there are many things investors should be aware of, as we all know that investing in energy stocks could give us a good return but could also be risky. First, we need to keep track of oil prices, track their dividends and payout ratios, know that there is a lot of volatility in the industry in this sector, and invest in companies with a low production cost with a strong balance sheet, conservative dividend payout ratio, and manageable capital spending. I said that this can be risky investment because we know that the energy sector is very important for the global economy, so it could easily get affected by it, just like it happened in 2020 with the pandemic. Yes, the energy sector provides the fuel and power needed by us to travel and drive from one point to another. But if the economy slows down, it can have a major impact on energy demand and prices. For example, a year ago, the demand collapsed, but the supply was not able to adjust as fast as demand, so tanks filled up really fast to a point where prices actually went negative for a period of time. Then producers were able to catch up and adjust, cutting production and cutting capital spending, until now that we are seeing the demand going up strongly, but we can still see the supply responding more slowly than demand. So what happened is that we saw a decrease in storage last year in storage capacity, and the market running out of storage capacity led to an increase in storage prices, as the supply is not able to adjust as fast as demand. But now we are seeing the demand growing and supply almost back to normal, which is why we are seeing oil prices going up as well, which is why I believe it is important to focus on stocks of companies that can survive a downturn. Now let's compare both companies. Okay, so as we can see here, I did a little chart with a lot of very nice information and important information for both company Exxon and Chevron. As we can see here, that the current market cap here, the biggest one is Exxon with $267.20 billion versus Chevron $216 billion. Now, a forward PE of 12.17 for Exxon and 14.56 for Chevron. And obviously this point goes to Exxon as it has the lowest forward PE at the moment. But then when we see the 5-year average PE, we still see that Exxon have had the lowest 5-year average PE in comparison to Chevron, 24 for Exxon and 32 for Chevron, meaning that at the moment a PE discount for Exxon is 49%, but while Chevron is 55.21%, meaning that Chevron might have more potential than Exxon at this moment. But this is just one possibility. This is just one metric. We should not only evaluate a company with one metric, but this point definitely goes to Chevron. Now, in the stock price, this is just a stock performance. We can see that Exxon is at $63 per share, while Chevron $112 per share. The 52 weeks high for Exxon is $64 and the 52 weeks low is $31, meaning that the stock is down 2.85% since its highest point in the past 52 weeks. While we can see that Chevron 52 weeks high is 113 and 52 weeks low is $65 per share, meaning that it is only down 0.76%. We can see this in two different ways. We can see this as Exxon having the highest discount at the moment, or we can see this as Chevron performing way better in the long term. So I would not put a point here, as you can see it different ways, and both ways are correct way to see it. Now, under revenue, we can see that Exxon had a revenue of 32 billion last year, quarter 2 2020, while Chevron $13 billion. But we don't care about this comparison. What we care about is the comparison in their growth. We can see that the revenue change in comparison with quarter 2 2020 and quarter 2 2021 was 89% for Exxon and 178% for Chevron. Here, Chevron wins the point, but I do have to say that both did pretty well. I understand that 178% is way better than 89%, but still 89% is pretty good. We do understand that this kind of growth is because of what happened last year in the pandemic with oil. It's not normal to see this kind of growth with this type of companies. Now, the profit margin, we can see here that the winner as well is Chevron with 8.10% in profit margin in comparison to Exxon with 7.30%. Now, on their balance sheet, we can see that Exxon have $3.46 billion in cash in hand. Chevron has $7.56 billion. Now, current assets, $54 billion for Exxon and $32 billion for Chevron. Total assets, $337 billion for Exxon and $242 billion for Chevron, while current liability is $62 billion for Exxon and $28 billion for Chevron. But what you guys know, what I like here is to compare is their current ratio and total liability to total asset ratio, which we can see that the current ratio for Exxon is 0.88, but for Chevron is 1.17. And you guys know that I like the current ratio to be above 1 to 1.2, and everything about 1.2 is way better. There is none of them have a current ratio of above 1.2, but still here we can see that Chevron takes the point because it is at 1.17 and is way higher than Exxon and also higher than 1. But still, the total liability to asset ratio, we can also give the point to Chevron because in comparison to current ratio, we know that current ratio, the higher the better, but total liability to asset ratio, the lower the better, as it means that it has 45% of its liabilities in assets, while Exxon has 51%. So I prefer the lowest the better in here, and the point is to Chevron. Now, I will not put any points here as these are just analyst expectations, and we can see that they're expecting Exxon to grow 63.80% in revenue for the next quarter, this quarter 3 that they're going to report in the coming future, and 65% for Chevron. But for the whole year, they're expecting a 60% growth for Exxon and 58% growth for Chevron. So both companies are expected to have a very nice growth here. Now, this profit margin, I like to take the last year profit, but as 2020 was kind of crazy for this industry, they were not able to be profitable. So Fidelity also provides data by S&P Global Market Intelligence, which shows us that Chevron gross stability is above average at 90/100, and the quality is at 53/100, while we can see that Exxon stability growth is above average at 68/100, and quality is better than Chevron at 67/100. Now, something many people like about these companies is their dividends, as they tend to be high in the industry. As you can see, Exxon has a dividend yield of 5.55%, when the average in the industry is 2.33%. The only thing is that their payout ratio does not seem that healthy at the moment, but can be normal, as last year they were not able to be profitable. Still, we can see that they have not raised their dividends either in the last quarters or years. While Chevron has a dividend yield of 4.8%, they did raise it until 2020 but decreased this year, and we can see that the payout ratio is really high at the moment as well. Now, another way to have exposure to the energy sector is by investing in an ETF called Energy Select Sector SPDR Fund, which in the past year it have had a better performance than any of these two stocks that we just talked about. Same in the past 2 years, but not in in the past 5 years. Still, here are some of the holdings in the XLE ETF, so you could see that you would be having a huge amount of exposure for both Exxon and Chevron, but also to many other energy companies. I do understand many prefer to invest in individual stocks, but this is just for those that don't want or don't have the time to analyze more in depth any of these companies, but still want to have exposure to the energy sector. Thank you and see you next time.